Yes, 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 yes. Good evening to you all. Good evening, good evening.
Good evening, sir.
Yes, we are here. We are going to be looking at financial statements for sole traders. That is our topic for today. Having, look, having looked at the preparation of the trial balance after posting transactions to the ledger accounts, balancing of the ledger accounts, and then extracting a trial balance. Today, we want to look at the preparation of the financial statements. We need to assess the performance of the business. Is this business making profits or they are making losses? We need to look at the resources that the business controls at the end of the financial period. We need to find out the obligations the business has at the end of the financial period. What is the equity of this business? So we can find out all that by preparing what we call the financial statements. So by preparing the financial statements, we can be able to tell that this business is performing well or it's not performing well. So what we are going to look at in this lecture, we are going to see how to come up with a statement of profit or loss, and then how to come up with a statement of financial position. How do we come up with a statement of profit and loss? And then how do we come up with a statement of financial position? That's what we are going to be looking at in this lecture. So when it comes to the financial statements, all you need to know about the statement of profit or loss, what you have to know is that the statement of profit or loss has two sections. It has two parts. It has what we call the trading account, and then it also has what we call the profit and loss account. So we are going to see how do we come up with a statement of profit or loss, and why do we prepare the statement of profit and loss. So the statement of profit or loss is split into two parts. The first part is known as the trading account. The first part is known as the trading account, and that trading account gives us the figure for gross profit. The trading account gives us the figure for the gross profit. Then the second part calculates what we call the net profit of the business. The second part calculates what we call the net profit of the business. And to arrive at the net profit, we get the gross profit, then we deduct the operating expenses. We get our gross profit, we deduct the operating expenses. Now, the statement of profit or loss shows the performance of the business over the accounting period. I've told you, if you want to assess whether the business is making profits or not, you need to prepare the statement of profit or loss. So that statement is going to show you the performance of your business over the accounting period. When we talk about the accounting period, normally here we are referring to a period of 12 months. We are referring to the period of 12 months. That is the accounting period. So the statement of profit or loss will show you the performance of the business over a period of 12 months. The statement of profits or loss, it contains what we call the incomes. It contains what we call the incomes and the expenses for the business. So we have to find out what are the business's incomes and what are the business's expenses. Sales revenue is the income of the business. Remember, the business will sell its products to the customers. The business will provide services to its clients. So that revenue they collect from the provision of the services, the revenue they get from the sale of goods, that is the income of the business. That is the income of the business. This could be sales made in the shop. We have some example here. That this could be the sales made in the shop, or the invoices sent out to customers. It can be referred as sales revenue, sales, or just income. So when you make sales, whether on cash, whether on credit, all that will make your income. So sometimes you find sales revenue. In some scenarios, you may find sales. In some other scenarios, you find incomes. So you've sold your goods and you've received money. You've received the cash, which we refer to as the sales revenue, which is the income to the business. But now ask yourself, yes, I've sold the goods, but what is the cost of these goods I've sold? What is the cost of the goods I've sold? Such that you can arrive at what we call the gross profit of the business. So I always have to find out how much is the revenue? How much have we collected from the goods we have sold? And then what is the cost of these goods we are selling? Take an example. If you buy a bag of sugar, if we buy a bag of sugar at how much? How much is a bag of sugar? A 50-kilogram bag of sugar. Yes, how much is a bag of sugar? A 50-kilogram bag of sugar. We want to see how we can get the gross profit. So if the cost of sugar, that is our 50-kilogram bag, assuming we buy this at 300K, that is the cost. We have paid 300,000 to get a bag of sugar. But then you find that we are going to sell this bag at 400. 400,000. That is the sales. So we have made sales of 400,000. We have sold all the 50 kilograms of sugar, and we have made sales of 400. We have collected 400,000 from the sale of that 50 kilogram bag of sugar. Now here we have a profit. How much is that profit, members? How much will be the profit?
100,000.
100K.
The profit is 100,000. That is your profit. But we call this the gross profit. It's not the final profit of the business. Why? Because here I'm just looking at the cost of the sugar, which is 300. Then I minus the sales we have made from the sale of that sugar, which is 400,000. So we have made a profit of 100,000 just on trading. The cost was 300, and the sales we have made is 400,000. So we have made a gross profit of 100,000. So gross profit is simply getting the sales minus the cost of the goods you have sold. That will give you the gross profit. But remember, it's not the net profit. Why? Because the business will incur some other expenses for it to be able to run. Expenses like what? What are some of those expenses the business is going to incur? For example, which expenses?
Transportation of the sugar to the shop.
Transportation of the sugar to the shop. Perfect. That is carriage inwards. Thank you. Then which other expenses? Which other
You may have rent.
Rent.
Rental.
Sometimes you find that you're renting. You're what? You're renting. So you have to pay rent. Then what was apart from rent?
Electricity, maybe.
Also, sir. Salary.
The salaries, assuming you have a shop attendant in the shop, you have to pay salaries and so on, and many other expenses. So the other one is the gross profit. But now if I want to find out the net profit of the business, that's when I bring in these other operating expenses. Those other expenses that are incurred to run the business. So to get the cost of sales, how do we arrive at the cost of sales? Cost of sales is made up of the opening inventory. So cost of sales is made up of the opening inventory. On that opening inventory, we have to add the purchases we have made during the period. And then we have to less the closing inventory. Because at the end of the period, you'll be having some units, you'll be having some products, some kilograms of sugar, some bars of soap, some, and so on, that remain unsold as at the end of the trading period. As at the end of the trading period. So to get the cost of goods sold, we get the opening inventory, we add the purchases, then we less the closing inventory. That is how we get the cost of goods sold. And to get the gross profit, we get our sales revenue, the money you've collected from sales. Then you minus what we call the cost of sales. You minus the cost of sales. Then you get what we call the gross profit. But I've told you that is not your final profit. Why? Because there are some other expenses you incur for you to run the business. Those expenses have to be deducted from the gross profit now to arrive at what we call the net profit of the business. So to get the net profit of the business, we have to get our gross profit. Then we minus these other operating expenses. After arriving at the net profit figure, that is the figure which is going to be used to calculate the tax owed by the sole trader. So to determine the tax you're going to pay, first determine your net profit, because the tax will be computed based on the profit you have made. So we have a full format. I have shared these notes in the group. Someone was asking on which page is this, but these notes were shared in the group. So you just need to check in the previous text, you will see these notes. Now, how do we prepare the income statement? The format is here on your screen. The format is here on the screen. So you will see you have to write the heading that the income statement or the statement of profit or loss for the year ended 31st December 2009, assuming that is your financial year end. So you have to show the heading. You start with your sales, but as you know, sometimes when you sell the goods, customers can return back some of the goods to you. The customers can return back some of the goods. Those are called sales returns or sales return inwards. Sales returns or return inwards. So when you make sales and customers return back some of the goods, then you have to minus the sales returns from the sales you've made to get what we call the net sales or the net revenue of the business. Then we have to list the cost of sales. And to get the cost of sales, I've told you, you get the opening inventory. You add the purchases that the business has made during the period. But sometimes, as someone said, that you have to incur transport on the goods, to transport the goods you've purchased. You have to incur transport for you to be able to transport these goods, to move them from the supplier to your stores. So there will be carriage of purchases. Carriage of purchases, that is the transport you incur when purchasing, because as you're purchasing, you have to move these goods from the supplier to your stores or to your shop. So you have to add the carriage of purchases to the purchases figure and the opening inventory. Then you have to less what we call the purchase returns or the return outwards. Because sometimes you may purchase goods from the suppliers, but you find that some of these goods are returned back to the suppliers due to various reasons which we all know. What are some of the reasons for the business to return the goods back to the suppliers? Which reasons do we have? Under what circumstances can goods be returned back to the suppliers?
Poor quality products.
Poor quality product, that is good. Then what else?
Expiry date.
Damage the product.
Sometimes you may find that what they have supplied is different from what you had ordered. Sometimes you may find that the goods are expired. Okay. So
delay in delivery.
back. Sorry?
Delay in delivery.
Delay in delivery that maybe have ordered and the supplier has delayed to do the delivery. By the time they deliver those goods, you may be like no longer interested in the goods, so you can return them back. And many other reasons, of course. So we get our opening inventory, we add the purchases, we add the carriage on purchases, we less the purchase returns, then we get what we call the cost of goods available for sale. The cost of goods available for sale. But don't forget, there will also be scenarios when the owner of the business withdraws some goods for private use. We have in my shop, then I take out some products from the shop, but for my family, those are drawings. So if we have goods that are withdrawn from the business, then they are also going to reduce your goods that are available for sale. So if I have goods that have been withdrawn, then still I will show that under this part of the cost of sales as a deduction. So I also have to list the goods withdrawn if they are there. Goods withdrawn. We have to list the goods withdrawn if they are also there. We have to list them because they are going to reduce the cost of those goods that are available for sale. So that is now the cost of the goods available for. That is the goods available for sale. So what you have to do now, you have to add your opening inventory, you add purchases, you add the carriage on purchases, you raise the purchases returns, then you transfer the figure here, then you get the goods available for what? You get the goods available for sale. After getting the goods available for sale, then you have to list what we call the closing inventory. Why? Because these goods are available for sale. This is the total value of all the goods that you have that are available for sale. But remember, at the end of the period, some of the goods may remain unsold. That is closing inventory. So that closing inventory will have to be deducted from the cost of the goods available for sale. Then we get the cost of sales figure for us to be able to arrive at the gross profit and the gross profit, as you can see. On that gross profit, normally there may be some other incomes other than the incomes from the sale of goods. The business can receive a discount from its suppliers. The business can receive commission. The business can receive interest. So there will be those other incomes which you have to add on the gross profit to get what we call other incomes. And when you get those other incomes and you add them to the gross profit, then you get what we call total incomes, or sometimes it can be referred to as gross income. It can be referred to as gross income. After getting that gross income, then we have to less all the operating expenses which you know, light and heating, advertising, wages and salaries, rent, administrative expenses, discounts allowed, depreciation on sale, carriage of sales that is carried outwards, commissions payable, interest payable. You have to list all those operating expenses from your gross income for you to be able to get what we call the profit for the year. For you to be able to get your profit for the year. Someone is asking, why are the recordings in different colors? Oh, now I'm just highlighting some words have been highlighted. Some words have just been highlighted because they are very key in those different paragraphs. Yeah, Catherine was asking on YouTube, why are the recordings in different columns? I think he's talking about I don't know, but I don't know why. I think in the notes, the formats you have, some figures are in, some columns are in, some headings are colored, others are not colored, but we shall come to that. Harriet is saying expired goods. Oh, I think she was talking about the circumstances under which goods can be returned back to the suppliers or customers returning back goods. Now that is the profit and loss. Sometimes you can call it the income statement. Now, I welcome your questions so far from the discussion we are having. If you have a question so far on the income statement only, you can ask that question before we go into the second statement. So if you have questions about the income statement, please ask them before we move into the next part. Those with the questions, please. Yes.
Excuse me, sir.
Yes.
Is the income statement the same as the financial statement?
Is income statement the same as financial statements? Sanyu and the rest, the income statement is one of the financial statements. Okay? The income statement is one of the financial statements. Okay? So it's one of those financial statements which a business can prepare. Okay? Hope I've answered you. It's one of the financial statements.
Yes, thank you, sir.
Then in the chat box, can we also use two columns in the income statement? Yes, it is possible you can use two columns. Here you're seeing three columns, but I can still use two columns as long as all the information has been presented. It's okay. I can use two columns as well, or three columns like in this case. Any other question? Any other question? Those on YouTube, do you have questions, please? If you have questions about the income statement, you can ask them. Catherine, Harriet, Brian, David, Rebecca, Carlson. If you have those questions about the income statement, please ask them. Any more questions, members, before we move into the second statement? Do we have more questions about so far what we have covered? No questions. Okay, so in summary, the income statement shows the performance of the business. It shows the financial performance of the business. And how can you measure the financial performance of the business? You can look at profit. So profit or loss is one of the measure of the performance of the business. Okay, okay. So that is the income statement. So if you want to see the business making profits or loss, then you have to prepare the income statement. And the income statement is one of those financial statements that a business can prepare. You get your revenues, less the cost of sales, to get the gross profit. From that gross profit, you add those other incomes other than the revenue, you get the gross income. Then you minus all the operating expenses, then you come up with what we call a net profit. So that is the income statement, or sometimes you can call it the statement of profit or loss. Now, the second financial statement which a business can prepare, that is called the statement of financial position. That is called the statement of financial position. Sometimes you can call it the balance sheet. In some scenarios, or in some cases, you will see that this is referred as the balance sheet, but we shall be using the name statement of financial position. Statement of financial position. Now, what is a statement of financial position? A statement of financial position is a list of all assets of the business, its liabilities, what it is, the list of all the assets, equity, and liabilities of the business at a given date, usually the last day of the accounting period. Usually the last day of the accounting period. That is the balance sheet or the statement of financial position. It's a list of all the assets, the equity, and liabilities of the business at a given date, usually the last day of the accounting period. So all the balances for assets, all the balances for the liabilities, all the balances for the equity items, they will appear on the statement of financial position, which we call the balance sheet. The statement of financial position shows the assets, equity, and liabilities of the business. However, when it comes to non-current assets, so when it comes to the assets we class them into two main categories. Those are the current assets as well as the non-current assets. What is the difference? Who can tell us what is the difference between current assets and the non-current assets? How can you differentiate the two? Current assets and non-current assets. Any trial? Members, what are non-current assets and what are current assets? Louis, Esther, Michael, Barbara, Annette, Dasha, Faith, Kate Brown, Rodney, Macklin. What are non-current assets and what are current assets? How do they differ? How do they differ? Those on YouTube, Harriet, David, Catherine, Innocent, what are non-current assets and what are current assets?
Excuse me, sir.
Yes, yes.
I know. Can I try?
Yes, yes, please, you can. Yes.
Yes, I think that the major difference between current assets and non-current assets is that for current assets, these are assets that are expected to bring in quick income. They are short-term, whereas non-current assets, they are long-term assets which are expected to bring in income over a long period of time.
Perfect.
Hello.
Thank you so much. Yes.
Can I try?
Yes, sir. Patrick, it's okay. Try.
Yeah. To me, current assets, those are assets that can be converted to cash within a year, and non-current assets are assets that cannot easily be converted to cash within a given period of time, like in a year.
Thank you, Taban. That's also perfect. Yes, that the non-current assets cannot easily be converted into cash. Yes, the current assets, we can easily convert them into cash. Brian Mwanje, current assets are liquid assets. Thank you so much, Brian. This is perfect also. Current assets are liquid. You can easily convert them into cash. Thanks so much, Brian. Okay. When it comes to non-current assets, these assets were bought by the business, but not for the purposes of sale. We expect to use them in the business for a long period of time. So they are not brought primarily to be sold. They are expected to be used in the business, and they are expected to be of use to the business for a long period of time. And examples include the buildings, the machinery, the motor vehicles, the fixtures and fittings, and so on, land, furniture, etc. So assets, as we are presenting them, we have to categorize into those two categories, non-current and then the current. Now, the non-current assets, we present them at their cost, less accumulated depreciation. We present them at their cost, less accumulated depreciation. Why? Because for them, they depreciate. We have to minus their accumulated depreciation when we are presenting them in the statement of financial position, or what we can call the balance sheet. Someone is saying here in the chat box that non-current assets are fixed assets. Okay. Maybe what you can say is that sometimes if you don't use the term non-current assets, you can use the term fixed assets. Okay. So non-current assets They are fixed assets as well. And current assets are liquid assets. Okay, thank you. So those are the non-current assets. We have to present them at their cost. Then we raise the depreciation, we raise the depreciation. David on YouTube, non-current assets are assets which with a long term, which are long term, then current assets are made for resale. Harriet, non-current assets are fixed assets that are used for operations such as machinery, building, while current assets are non-fixed assets. Okay, thank you so much. Thank you so much, those who are watching from YouTube. Thank you so much. I will be going through your messages here. Okay, so those are the non-current assets. Now we move to the current assets. Members have said that current assets are liquid assets. These assets are always held for resale. We can easily convert them into cash. So the current assets, we have to list them next after the non-current assets. And these are those assets that are likely to change in the short term, certainly within the 12 months of the balance sheet date. So within a period of 12 months, these non-current assets can easily be converted into cash. You can easily convert them into cash. Examples include the inventories, those goods that are held for sale at the end of the accounting period, the accounts receivables, the cash at bank, the cash in hand, those are the current assets. So when we add the non-current assets, we add them to the current asset, then we get the total, which is known as our total assets figure, which is known as the total assets, which is known as the total assets figure, which is known as the total, which is known as the total assets figure. Then after the assets, what do we do next? After showing our assets, now we have to move to the second part or the second section of the balance sheet, which is the financed by section. So in that section, we have to show the equity of the business. That is the opening capital. So we have to show the capital of the business. On that capital, we have to add the gross. So we have to add the profit, which is taken from the statement of profit and loss, which we have looked at before. So we get our capital, we add the profit of the business. Then sometimes if there are drawings, we have to list the drawings because drawings reduce the business's capital. Drawings reduce the capital of, drawings reduce the capital of the business. So if we have drawings, these drawings we have to minus them. There is a message here in the chat box. So Mr. Voice is low, but I'm trying to be loud, very, very loud. I don't know why the voice is too low. Members, is my voice too low or because I thought I'm
No, you are loud
very
and clear.
I'm clear.
You are not too low. You are clear.
Okay, correct. Thank you. Okay, so we have to show the equity part. Nakasaga Paula, excuse me, sir, can you please explain more about the current assets, please? This is a message on YouTube. Now, Nakasaga, when you talk about current assets, these are assets that can easily be converted into cash within a period of 1 year. Those assets which can easily be converted into cash within a period of within a period of 1 year. For example, the accounts receivable, that is the money owed to the company by its customers. The inventory, the goods that we have, the goods that are held for sale or used in production, those are all current assets. Why? Because we can easily convert them into cash. Even the cash at the bank and the cash in hand, those are all current assets. Okay? Those assets which you can easily convert into cash within a period of 12 months, those are current assets. Paula, those are current assets. Those are current assets. Those are current assets. Okay, the voice is perfect. This is for YouTube. Okay, So we have to show the equity part. We get our opening capital, we add the profits, then we list the drawings if they are there, because sometimes the business, maybe the owner of the business may take out some goods. So those goods that are being taken out of the business and the cash that has been withdrawn for private use, that will reduce the capital of the business. Then we move to the part of liabilities. What are liabilities, by the way? We looked at liabilities during our introductory topics. What did we say about liabilities? What are liabilities? What are liabilities? Who can explain the term liabilities? What are liabilities? Yes, members, what are liabilities? Who can explain liabilities? Flores, Faith, Bridget, liabilities. What are liabilities? Oh, that when you're using the phone, it's slow. I think you can get some headsets maybe. Sorry about that, but the voice is low. Members, what are liabilities? What are liabilities? Who can explain liabilities?
Liabilities are financial obligations that a business or an individual owes to others.
The obligations of the business, those are liabilities. The obligations of what? The obligations of the business.
Sir, I think liabilities.
Yes, Karen.
Liabilities are like financial issues.
Yes,
Someone must settle
liabilities.
in the business.
Hello?
Yes.
First, let me try.
Yes,
Let me
Pastor.
try.
Yes, Pastor.
Hello? Liabilities.
Yes.
Liabilities. These are the debts of the business or of the company.
Okay,
Those are
thank you so much,
liabilities.
Pastor. Liabilities, those are debts or obligations that a person or a company owes to another party. Those are liabilities. Pastor, you mute. Yeah, so those are the liabilities. The debts or obligations for the business. There is something in the chat box here. Liabilities are the claims a business is supposed to pay. Thank you so much. Thank you so much. So those are financial responsibility that needs to be fulfilled. There is something still here. Liability refers to cash or assets that the business owes. Okay, so yeah, we have to present the liabilities. But now when we are presenting the liabilities, these liabilities have to be categorized. We have to categorize them. Brand is saying claims against the business. Okay. We have to categorize these liabilities into two categories. That is non-current liabilities as well as the current liabilities. So when it comes to the non-current liabilities, those are expected to be paid for more than a period of 1 year after the balance sheet date. Those are the non-current liabilities. Those items that have to be paid more than a year after the balance sheet date. Then the examples include bank loans, loans from other businesses. Which are the examples of liabilities, the non-current liabilities? Those liabilities that can take a period of 1 year when you're paying them. There can be deferred taxes, those are the deferred taxes. Sometimes there can be bonds payable. Okay, bonds payable, because normally bonds take a period of more than 1 year. So those will all be non-current liabilities. Then we have to present the current liabilities next. And those are the items that have to be paid within a year of the balance sheet date. So the current liabilities, you expect to pay them within a period of within a period of 1 financial year. That is a period of 12 months. Examples include the bank overdrafts, the accounts payable that result from the purchase of goods on credit for resale. Those are all current liabilities. Then thereafter, we have to get the total equity. We get the non-current liabilities and the current liabilities. Then we total them together to give us the total equity and liability figure. To give us the total equity and liability what? And liability figure. The final figure should be the same as the total assets figure from the first part of the statement. And now we have this format. Look at the format. That is the format of the statement of financial position. You see, you start with the non-current assets. You present them. You show the fixtures and fittings, the property, plant and equipment, and many others, depending on the information you have. You get their total. You move to the current assets. You present them. You get your total assets figure. Total assets, that is current assets plus the non-current assets. Then you go to the equity, you bring your capital, you add the profit for the year as you can see, then you list the drawings, then you get the total equity of the business. Then you move to the non-current liabilities. Under non-current liabilities, you see you have to show those long-term loans if they are there. Then you move to the current liabilities, credit payables, other payables. You show the bank overdrafts if they are there. Then you get your total current liabilities. Then you get equity. You add all the total liabilities. Then you get total equity and liabilities. Now, in accounting, when you're preparing this statement of financial position, there is something which you should not forget. As you're preparing the statement of financial position, you should not forget what we call the accounting equation. We have what we call the accounting equation. When it comes to the accounting equation states that assets will always equal liabilities plus what? Plus equity. When you prepare the balance sheet, your total assets figure should always be equal to the total of liabilities and what? Liabilities and equity. So the accounting equation is very key when you're preparing the balance sheet, or what we call a statement of financial position. Now, questions about the balance sheet before we go into our class example. Any question about the balance sheet, please ask your questions. Those on YouTube, share your messages here in the live chats. Ask your questions if they are there about the balance sheet. If there is something which you need to know about these two statements we are going to look at, please share those questions very fast. We'll answer them. Then we'll go into our question for today. Any questions so far? Questions about the balance sheet or the statement of financial position? Please ask those questions. Ask those questions. Before you go into the example, did I assume that everything is okay? Is everything okay? Is everything okay? Should we move to the example? Should we move into the example, members? Is anyone with a question about the statement of financial position? We don't have questions so far. Should we move into our question now? Okay, no questions, no questions. We have no questions. Now let us move to our question, which we are going to do. Let's move into our question now. Let's move into our question. The review question. Now, those on our weekend program, Those on weekend program, this question is there in the notes. Distance program, you will use the handout I shared in the group. This question is there. F. Brown. This question is there. But still, I think even this question is there in the distance notes. That weekend it's page 80. Those on weekend, you check page 80. This question is there. So, what someone read for us? The question. Who is going to read for us? Who is going to read for us? Dasha. See, Dasha. Dasha, can you read for us the question? We go through it very fast.
Review question 1. F. Brown drew up the following trial balance as at 30th September 2008. You are to draft the trading and profit loss account for the year ended 30th September 2008 and a balance sheet as at the date. Capital. Capital 49,675. Drawings 28,600. Cash at bank 4,420. Cash in hand 112. Carriage inwards 760. Stock 30th September 2007 72,410. Creditors 26,300. Debtors 38,100. Van 5,650. Office equipment 7,470. Sales 391,400. Purchases 254,810. Return inwards 2,110. Returns outwards 1,240. Carriage outwards 2,850. Motor expenses 1,490. Rent 8,200. Telephone charges 680. Wages and salaries 39,600. Insurance 745. Office expenses 392. Sundry expenses 216. And then I'm seeing, I think these are totals. 468,615. Stock at 30th September 2008 was shillings 89,404.
Okay, thank you, Dasha. So members, that's the question which we are going to use. We are going to see how we can prepare the statement of profit and loss, and then the balance sheet using that information. I'll be a bit fast, so I expect you to be having question, be having your book there, your calculators, a ruler, if possible. Then we see how we can prepare this statement very fast. Rogers, we are doing the question now. Younger, David, we are doing our question in the handout. We want to see how to prepare the income statement and then the statement of financial position very fast. We have 1 hour. So let's see how we can use that 1 hour to cover up those two statements. So what's the name of the business? I've shared my screen. I don't know whether it's clear now. What's the name of the business? The business is what? What's the name of that business?
F. Brown.
So we have F. Brown statement of profit or loss. For the year ended when?
For the year ended 30th September 2008.
30th September 2008. So I don't know whether the screen is clear. Please, you need to confirm whether everything is clear. Is my heading okay?
Yeah, it's clear.
Okay, so that is our heading. That is our heading. Okay, so that's the heading. Now, as you're writing that heading, you have to show the name of the business. So in this case, F. Brown is the name of the business. The statement you're preparing, and then the period. Okay, so that is our heading. So now what do we need? We need to bring the sales. We need to bring the sales revenue. You have to show the currency. So these amounts are in shillings. These amounts are in shillings. So the amounts are in shillings. So we start with the sales. We need to find out how much are the sales for this business. So the sales revenue, you check in the question very fast, then you read for me the sales. Let's do this very fast. How much are the sales? How much are the sales?
3,900.
How much?
391,400.
39,000. Is it 391,400?
Okay, that is our sales figure. We have the sales 391,400. So you put those sales. I'm using 2 columns, but still you can use 3 columns. So that is the sales. Now you have to ask yourself, you have to find out if the business has sales returns or return inwards. So do we have the return inwards? Do we have return inwards? Please look through the question very fast, very fast. I'm waiting for your feedback. We have returns. I want us to do this together. Do we have returns? Look through the question. Do we have the sales returns or return inwards?
Yes, we have return inwards.
How much are the return inwards?
2,110.
2,110. Those are the return inwards. Now, these return inwards, we have to minus them to get the figure for the net sales figure. We have to minus them from the revenue, because now these goods are being returned. So we have to deduct them from our revenue to get what we call the net sales figure. So net sales revenue, which I can move to the last column. It is this minus that. Is that okay? net sales revenue. I'm getting my sales revenue. Then we less the returns that were made. Then after that, we have this, the cost of goods sold, or the cost of sales. Okay, the cost of the sales, we have to minus the cost of sales. How will we get cost of sales? What is the formula for computing cost of sales? What do we start with?
The opening stock, the opening inventory.
We get our opening inventory, and that opening inventory, you'll find it in the trial balance. Opening inventory, you'll find it in the trial balance. So how much is that opening inventory? How much is the opening inventory? Check the trial balance. That opening inventory is there. The inventory in the trial balance is the opening. How much is that? That is the stock on 30th September 2007. The stock as at the end of the previous year. That is now our opening inventory here. The opening inventory, we have that. On that, we are going to add the purchases that were made during the year. So how much were the purchases?
$254,810.
254,810. That is your purchases. You have added the purchases to the opening inventory. But in the process of purchasing, sometimes you find that the business may incur carriage inwards, carriage of the purchases. So do we have that carriage of the purchases or carriage inwards?
Yes, we have carriage inwards.
Carriage inwards, how much do we have?
760.
760. Okay, carriage inward, we have 760. Then what else do we have? Do we have returns? Because sometimes you may find that the business is returning back some of the goods. So do we have returns?
No.
Return inwards. Do we have return inwards?
We have.
We have return inwards. So how much?
Yes, it is there.
Yes, so we saw much.
2,110.
No, that is inwards. We want to return outwards, rather return outwards, not inwards. Return outwards.
1,240.
1,240. Those are the return inwards. Return inwards. Normally you can get the net purchases figure, which is the purchases plus the carriage inwards, then minus the return outwards. This gives you the net purchases figure if you wanted to get the net purchases, where you get the purchases plus the carriage inwards, then you less the return outwards. You can call that figure net purchases. That is your net purchases figure, just in case you want to also show that. Then when I get the opening inventory, I add my net purchases figure. Then there we can get what we call the cost of goods available for what? Available for sale. Cost of goods available for sale. Cost of goods available for sale, and that is 326,740. That is the cost of goods available for sale. After getting that cost of goods available for sale, then we can less the unsold goods at the end of the year. That is less closing inventory. And closing inventory, you'll find it in the additional information. It always appears in the additional information. So how much is the closing inventory as per the additional information?
89,404.
404.
89,404. Oh, sorry. 89,404. That is the closing inventory. So when I get my cost of goods available for sale, I minus the closing inventory, then you're going to get your cost of sales figure. You get your cost of sales figure, which you will transfer to the last column, and that is this minus this. That is the cost of sales. That cost of sales is minus from the net sales revenue up there to get what we call the gross profit. Our gross profit is that. Any questions so far before we continue? If you have something which is not clear, please raise any inquiry, please you can ask. If you have a question. This is our gross profits for the business. That is our gross profit. Now, to get that gross profit, normally you have to add those other incomes if they are there. We have to add those other incomes if they are there. So try to check through the question and see if you have discounts received, rent received, interest received, commission received. Try to check and see if you have those incomes. Do we have those incomes?
We have rent.
Sorry?
We have rent only.
Rent received. We want rent received, not rent. That is an expense. The rent you see is an expense. We need rent received. Rent received.
Okay.
That is an expense. The chat box. How do we get the gross profit? To get the gross profit, we have got the net sales revenue up here. This, your net sales revenue, this, and we have minus the cost of sales figure. So we have got the net sales revenue, then we minus the cost of sales figure to arrive at the gross profit. So we don't have those other incomes. If they were there, then you have to add them to the gross profit. But it's like we don't have. So what I'll do, I'll just go straight to the expenses. We have less the operating expenses. So less operating expenses. Less the operating expenses. And these operating expenses, they are there, we have them. We are going to list them one by one. The operating expenses. So under operating expenses, what do we have under the operating expenses?
Rent.
And there is rent, good. So we have rent. How much is the rent?
8,200.
8,200.
200.
8,200. Which other expenses do we have? Neighbors. How are expenses?
Motor expenses.
Motor.
Expense.
Motor expenses. How much are the motor expenses?
1,490.
1,490. Then what else? What else do we have?
Office expenses.
We have the office expenses. Office expenses. How much are the office expenses?
392.
Office expenses, we have 390. 392. The office expenses. The expenses we have 392, 392. Then what else do we have? Which are operating expenses do we have here?
Sundry. What's sundry?
So we have the sundry expenses. How much are the sundry expenses?
260.
216. That are sundry expenses. What else do we have? Members expenses. Expenses. What else do we have? The expenses, wages and
Wages and
salaries.
salaries.
Thank you, Olivas. Wages and salaries. How much are the wages and salaries?
39,600.
49.
39.
39. 600.
Yes.
Okay. What else do we have? What else do we have under the expenses? We have what?
Telephone charges.
We have the telephone charges. Good. We have the telephone charges. Telephone charges. Thank you. How much are the telephone charges?
680.
680. What else do we have? What else? What else do we have? The carriage outwards. The carriage outwards. How much are the carriage outwards?
2,150.
2,000 what?
800.
2,850. Okay. What else do we have? What else do we have?
Insurance.
Insurance. Insurance expense. How much is the insurance?
745.
How much?
745.
745. That's the insurance. Good. What else do we have? What else do we have? We got operating expenses. Sorry? Van is not an expense. That is a non-current asset. I think that's it all. Not so?
Yes.
Rent we have, carriage outwards we have, the motor expenses we have, then the insurance is there, telephone charges are there, office. Okay, you add. Let's add and get the total operating expenses. Let's write add and get the total operating expenses. Let's do the addition now.
54,173.
Total operating expenses. $54,173. 173. Okay. So now after getting the operating expenses, we are going to deduct them from the gross profit to get what we call the net profit numbers. that how much is our net profit now?
$97,781.
Okay, so that is our net profit members, and that is the income statement, or you can call it the statement of profit and loss. So if you have a question, you can ask before you go into the balance sheet. Those will be questions, please ask them. So far on the income statement, if there's something you need to understand more, you have question, please ask before we go into the balance sheet. Those are the questions, please ask them. Questions about the income statement, ask before you go to the balance sheet. No questions. Okay, let's move to the balance sheet. So that is your income statement. This business is making profits. It made a profit of 97,781. That is the profit. That is their profit. So now we need to see the balance sheet part of it. Let's try to look at the balance sheet. Let's look at the balance sheet. So we have created a heading, as I told you already. This is F. That is F Brown statement of financial So let's say we can get how we can come up with our balance sheet. You operate your heading.
Hello.
Yes, please. Hello. Okay, so now we want to come up with a balance sheet, which is the statement of financial position. So as you see, normally we use 3 columns when preparing that statement, because we have to show the costs for the non-current assets, and then you also have to show the depreciation, that is the accumulated depreciation for the assets. So we always have to come up with all those 3 columns sometimes. So that is my statement. Already the amounts are in shillings, as we all know. So what we have to do now is to start entering the information. When it comes to the statement of financial position, we start with the assets. As I told you already, we have to first present the assets of the business. We have to present the assets of the business. So I'll say assets. But under assets, we start with the non-current. We start with the non-current assets. The question we are doing is just a basic question. You will not see the depreciation there, but we still have to look at depreciation. It's one of the topics which we are supposed to cover. We shall see how to calculate that depreciation, and then we shall have to get some questions where we have depreciation. But for now, the question we have has no any adjustments. It's just a basic question for us to at least get familiar with how we prepare the statements. So you will not see the depreciation in this case. Don't have it. So, but there is a column such that in case we find a question which has depreciation, you know where to put that depreciation. So let's start. The non-current assets, what do we have under the non-current assets now? What do we have under the non-current assets? Non-current assets, what do we have, members? Non-current assets, what do we have, members? Check those non-current assets very fast. We put them. We have 30 minutes to go. The non-current non-current assets, what do we have under non-current assets?
We have the van.
We have the van. Harriet, NBV is net present, net book value. NBV is net book value. That is cost minus accumulated depreciation. That value will come up with after deducting the depreciation of the asset from its cost. That is what we call net book value. Okay. So how much is the cost of the van?
5,650.
5, 6, 10. That is the cost of the van. As I've told you, we don't have depreciation. So meaning that under depreciation column, I'll just put a 0 because we don't have depreciation in the question. So the net book value of the asset will still be 5, 6, 10. To get net book value, you get the cost of the asset minus its minus its depreciation. But depreciation is 0 in this case. So from the van, which other asset do we have? Which other non-current asset do we have?
Office equipment.
We have the office equipment. How much is the office equipment? Its cost is 7,470. Depreciation for now, we don't have depreciation in this question, but the questions we are likely to do, the exam style questions will be having those end of year adjustments. But we first look at the end of year adjustments, then we shall get those questions with those extra adjustments. Then we see how to incorporate depreciation and then those other adjustments like prepaid expenses, accruals, and so on. But for now, we don't have those adjustments in this question. So our net book value will still equal to the cost of the non-current assets for now. The total is 13,120. That's your total. 13,120. Then we have to move to the current assets. We have to move to the current assets. We have to move to the current assets. Under current assets, we said we have inventory, and that is the closing inventory. Please, how much is the closing inventory figure? That is that figure after the trial balance, the additional information.
59.
How much is the closing inventory figure?
404.
Okay, so we can put that 89,404. Then we have to get the datas. This time they are calling them datas, but sometimes you find that instead of datas, they can use trade receivables or accounts receivable. So how much are the datas?
38,100.
Datas we have 38,100. Okay, 38,100. Then from the datas, you can bring your cash at the bank. That is your bank balance. So how much is that cash at the bank?
4,420.
4,400. That's our cash at the bank. Then cash at hand.
112.
112. That is your cash at hand. So those are the non-current assets those are the current assets which we have for now. What we have to do is to add them and take the output of the last column. So it is this plus the cash at bank, the datas plus the inventory, and that gives us 132,016. That is my current assets total, which now we can add to the non-current up to get what we call the total assets figure. So total assets that is total assets figure, as you can see. Message in the chat box. How did we get the cash at bank? The one who is asking about the gross profit, I think that's an old question. Okay, cash at bank. Cash at bank is 4,420, not 4,400. Let me first check. That cash at bank is 4,420. Okay, thank you for that correction. This is 4,420. The cash at bank is 4,420. Okay, thank you for that. How did you get to assets? How did you get assets? Total assets? Total assets. You're adding the total non-current assets. We're adding this. That is your total net book value of the non-current assets, then plus that. Okay, they have answered you non-current assets plus the current assets. Okay, thank you. So we are adding these two to get the total assets figure. We are adding the total current plus total non-current, get the total assets figure. From there, we have to move to equity. We have to move to equity and liabilities. We have to move to equity and liabilities. We have to move to equity and liabilities. Equity and liabilities. We have to move to equity and liabilities. And I'll start with equity. Start with equity. We have to show the equity. Want to see how this business is financed. And here I will start with capital. How much is the capital of this business? Let's get that capital. How much is the capital of the business?
49,675.
How much?
49,675.
600 what?
675.
675. Then on that capital, we have to add the net profit because this business made a profit. The profit from the other statement, right? Okay. How much is the profit?
97,781.
We bring our profit. That is this. That is our profit. When I add the capital, when we add the capital, we add our profit. That's what we get. Then on that, we have to list the drawings because there are some drawings here. Now, someone is asking, why are we recording the current assets under the column of accumulated depreciation? Remember, this column of the accumulated depreciation just works on the non-current assets. Okay? This just works on the non-current assets. Yes, I have three columns: the cost column, the accumulated depreciation, and then the net book value. These work on the current assets. For the rest of the items, don't mind about the naming of the column. So the naming of the columns cost, the accumulated depreciation, and the net book value only applies on the non-current assets. For the rest, the namings of the columns are not key. Just for formality that we have 3 columns, but these 3 columns mainly work on the part of the non-current assets that I have to show the cost, I have to show the accumulated depreciation, then the net book, then the net book value. But for the rest, so this is not depreciation. For the current assets, you're seeing the figures in this column, but now that is not accumulated depreciation for the current assets because for them, they don't depreciate. So this is not depreciation. The accumulated depreciation is just to cater for the non-current assets because for them they depreciate. Okay. So that is it. How much are the drawings? We have to list the drawings from this total. How much will be the drawings?
28,600.
28,600.
600.
600. Okay. So we minus the drawings because when you withdraw money from the business, capital is going to reduce. So I'll end up with the total equity, end up with the total equity, and that will be this minus that. So we get the total equity. Okay. Then what's next? That is our total equity. We can move to the liabilities, but I see we only have the current liabilities. I've not seen any non-current liability in the scenario. All what we have are current liabilities. Don't have the non-current liabilities so far. But we are going to put the non-current liabilities just in case you find another question with such liabilities. You include them. So non-current liabilities. Non-current liabilities. Non-current liabilities. We don't have any, so I'll just put a 0. We don't have. If we had them, then we can list them down there, but you see we don't have any of them. So I'll move straight to the current liabilities. We list them also. So under the current liabilities, what do we have under the current liabilities? Those ones we have them. Yes?
Debtors.
I beg your pardon? Under current liabilities, what do we have, members? We have the creditors, not debtors, the creditors. How much are the creditors?
26,300.
We'll just transfer that to the last column, 26,300. If we add more than one, we can list them in the second column, then we add and transfer the total to the last column, but we only have one current liability, and that is the creditors figure. So now we can get the total equity and liabilities. We can get our total equity and the liabilities. So equity and liabilities, I'll get our total equity. We add the current liabilities. We get 145,156. So that is your total equity and liabilities. And you see that total equity and liabilities is equal to our total assets figure up there. Don't forget that your total assets will be always equal to the total equity and what? To the total equity and the liabilities, as you can see. So that is your statement of financial position. With the practice, I believe everything will be easy with the practice. So you have to practice, of course. Though we need to look at the end of year adjustments, we see how to calculate depreciation, and then we see the impact of depreciation on the income statement, and then the balance sheet. Then we shall also look at end of year adjustments. We see how they impact your figures in the statement of financial position. So we are going to stop here, unless people have questions. If you have your questions, please feel free. You can ask them. We see if we can get solutions for those questions. Then we conclude for today.
Sir, I think we need more lecture on this topic for today. We need more lecture on this.
Okay.
We do it for the second time. Yeah, that was my opinion, sir.
Okay, thank you. Any other comments? Members, do you have any other question? Questions, please, if you have questions, ask. Thank you, sir. Okay. So, members, thank you so much. This is so better if we can have more online, sir. As for your asking you, where are you? Another example that has, you know. Okay. So members, thank you so much for attending. Thank you so much. Those who have been watching from on YouTube, the good thing I've been responding to all your comments and section and comments. I've been responding to all your questions. Thank you so much. I've read all your comments and I've answered all your questions. Yeah, thank you so much. So we shall start from there. Next time, those who have contributed, those who have been answering questions, thank you so much. Thank you so much for your time and the interest. So this is so better if we can have more online. One more example, another lecture on this topic, sir. Okay. We shall, maybe in our next class, we shall see if we can look at this. We master how to come up with these statements before we move into something else. All right, so those on YouTube, Harriet, Nakasa, Harriet is saying the topic is not easy. David, okay, thank you so much. Carrison, Libas, Harriet, okay. David, Amos, Innocent, Brian. Okay, thank you so much, members. We shall start.